Welcome to this video on Operation Silicon Siege. This dossier provides an in-depth look at Micron, ticker symbol MU, as we approach their Q3 fiscal year 2026 earnings, scheduled for June 24th. The AI trade is waiting for this print. Micron's results will offer a key insight into the health of the AI memory market. The stakes are significant, with a major 12-month run and a high options implied move. A quick compliance note. This video is for educational and analytical purposes only, not financial advice. Trading involves substantial risk, and market data can change rapidly. Our thesis: while Micron is benefiting from a real memory shortage, much of that financial gain is driven by price rather than volume. As price is a volatile input, discipline is our edge going into the report. We use a top-down operating system to analyze this: macro, fundamental, and technical. Understanding the broader war, the company's performance, and precise technical levels helps us make informed decisions. Walking into the earnings release, MU is trading at record highs with significant investor interest. With such high expectations and euphoria in the market, our disciplined approach is more critical than ever. Now let's look at the first pillar, the battlefield. We need to determine if the AI memory war is truly still ongoing. Micron is a major global player in DRAM and NAND memory. They are a true manufacturer, which makes their business a leveraged bet on the cyclical nature of the memory market. High bandwidth memory, or HBM, is the crown jewel here. It's essential for AI accelerators, and as hyperscalers increase their capital expenditure, demand for this constrained product remains strong. The current supply shortage allows for significant pricing power. However, management has acknowledged the extreme volatility of these prices. We must remember that pricing power can evaporate quickly. Last quarter highlighted this lopsided growth. Revenue grew primarily through higher selling prices rather than increased volume. This is highly profitable now, but presents risks if the market shifts. When major companies like Apple warn about rising memory costs, it confirms the industry-wide squeeze. This widespread demand adds credibility to the current bullish narrative. While token usage is exploding, we are seeing signs of deceleration in the rate of growth. This second derivative slowing serves as a potential early warning indicator for the chip sector. Efficiency is the next trend. Companies are looking to reduce costs, and more efficient inference models could eventually lower memory consumption, which may soften pricing power down the line. Finally, monitor the spot market. While it remains elevated, the fact that it has come off its peak is a signal to watch. It's a gauge, not necessarily a sell signal, but vital for situational awareness. Moving to our market map, it's clear there are three key players. Micron, as the third largest, acts as a price taker in this oligopoly. While this works beautifully when everyone maintains discipline, their smaller size means they are more sensitive to capacity shifts from the giants. The counteroffensive is underway. Micron has significant projects in Boise and Singapore coming online between 2027 and 2028. We are watching this closely, because when multiple projects ramp simultaneously, it could signal an end to the current pricing power. Policy is playing a role too. CHIPS Act funding and state incentives are lowering expansion costs, which accelerates supply. It's a double-edged sword, great for U.S. manufacturing, but it pulls forward the eventual supply-demand rebalance. We must also consider the tail risk. Much of the current AI infrastructure investment is debt-financed. If credit markets tighten, that capital expenditure could be cut, creating a, quote, macro trapdoor that would soften memory demand very quickly. Despite these risks, we are in the middle of a historic CapEx wave. As long as hyperscalers continue this arms race, their spending remains directly linked to memory demand, keeping the momentum underneath the sector for now. So far, there's no sign of a U-turn in that CapEx spending. Cloud and data center demand remain exceptionally strong. We'll be watching the guidance closely for any hints of a pause from the major buyers. However, there is a shift toward efficiency. Companies like Meta, Microsoft, and Walmart are reining in token maxing to curb unnecessary consumption. While this is a marginal headwind today, it's a behavior that could compound over the cycle. This leads to the, quote, efficiency cliff. As models become more efficient, the amount of memory required per task potentially decreases. If efficiency gains outrun the growth in demand, bit shipment stories could soften. High bandwidth memory remains the crown jewel of Micron's portfolio. It's the scarcest product they make, and is largely sold out, providing better visibility and margin than the rest of their commodity offerings. Looking ahead, the convergence of three major supply expansions between 2027 and 2028 is the key timeline. While pricing power looks solid for now, the supply pipeline is steadily building, and the clock is ticking. There is a debate on how long this lasts. Some see strength through 2030, but our take at Hollow Point Trading is more cautious. We see a potential turn after 2027 as that new capacity comes fully online. In summary, our macro scorecard shows strong AI demand and intact pricing for the near term. We are keeping a close watch on the supply pipeline and credit risks, but for now, the wind remains at Micron's back. Transitioning to our second pillar, the fundamentals. It's not enough to have a strong macro backdrop. We need to examine if Micron is actually delivering the financial results to back it up. The last print was historic. With record revenue and a 42% beat on non-GAAP earnings, Micron proved their ability to capitalize on the current market. These numbers set a high bar for the upcoming report. Finally, look at this revenue chart. It's gone vertical. Whether you are a bull or a bear, the core of the argument is the same. How much longer can this slope continue to climb? That is the answer we seek in Q3. Earnings power has shifted dramatically, with the company's EPS guide jumping from $1.56 to $19 in just 1 year. This illustrates the massive impact of operating leverage in the memory business, where costs remain fixed while price spikes translate directly into bottom-line detonation. Here is the bar Micron has set for fiscal Q3. They guided to approximately $33.5 billion in revenue and an exceptional 81% gross margin. With non-GAAP earnings projected at $19.15, these are record-breaking targets that reflect the current market shortage. Beating the guide is the baseline, but the market is already pricing in a beat. Analysts have pushed expectations to around $20 for EPS, meaning a simple inline result might disappoint. Bulls are looking for a raise in guidance, while bears are waiting for any hint of softness. We must remember the lesson from Broadcom. Even a strong quarter can trigger a sharp sell-off if guidance falls slightly short of perfection. High-momentum stocks often react to positioning rather than raw quality, so investors should prepare for volatility regardless of how good the headline numbers look. Looking at the business units, concentration is the story. Cloud memory is the clear growth engine and margin driver, fueled by AI demand. Meanwhile, mobile, client, and auto segments remain mixed or soft, showing that the company's performance is heavily carried by the data center sector. On paper, Micron screens as cheap with a forward PE in the low 20s. This valuation is supported by high teens growth, giving it a PEG ratio near 1. However, this relies entirely on pricing power holding up. Cyclicals are often cheapest at the peak, which is exactly when they are most dangerous. Street price targets have surged, with some now reaching as high as $1,500. Much of this upward revision is simply chasing the current market price. Remember that when analysts scramble to catch up to a rally, it acts as a momentum signal, not a margin of safety. Micron's capital discipline is a highlight. They are using their massive cash flow to deleverage, reinvest heavily with over $25 billion in capital expenditure, and return value to shareholders with a 30% dividend increase. This is the classic playbook for a company navigating the top of a cycle. The 81% gross margin is perhaps the most striking figure. For a commodity business that historically struggles to break even, this level of profitability is a clear sign of a supply-driven windfall. The critical question for investors is whether this is the cycle peak or just another step higher. The balance sheet management remains strong. By prioritizing debt reduction while simultaneously funding aggressive capacity expansion, management is positioning the company to survive a potential downturn while capturing market share today. This strategic balance is essential for long-term survival in such a volatile industry. Here is the single most important takeaway. This quarter is almost entirely a price story. Bit shipments have only grown in the single digits. Because pricing is the most volatile variable in their model, the company's entire earnings trajectory is built on a very fragile foundation. Specifically for DRAM, revenue jumped 74%, but the gains were dominated by price hikes. While this is wonderful for the bottom line during a shortage, it is the first thing that will reverse when supply catches up to demand. NAND followed a similar trend, with revenue up 82%, again heavily driven by price. As AI agents demand more persistent storage, this segment becomes increasingly vital, but it remains just as exposed to price volatility as the rest of the business. The valuation paradox persists, a massive year-to-date run followed by a low PE ratio. This only works if earnings continue to accelerate as expected. If the shortage eases and pricing slips, those forward earnings estimates and the stock's valuation could see a significant adjustment. In conclusion, Micron is making a massive, multi-billion-dollar bet on their own future capacity. This capital spending is both their greatest moat and their biggest potential risk, as the facilities they build to protect share today will eventually contribute to the supply that cools the market tomorrow. A 30% dividend hike signals management confidence. Returning cash while investing and deleveraging is rare for a cyclical at its peak. It shows they see durable cash flow, making this a long-term tailwind. This is an elite, well-capitalized, cyclical. However, with record numbers, price-driven earnings, and sky-high expectations, it remains a risky play unless the cycle holds. Now, we shift to the technical pillar. It's time to determine where, and whether, to pull the trigger. We are looking at a parabolic run into a binary event. The trend is strong, but momentum is stretched. Don't try to predict the candle. Define the levels that change the read. Map your zones before the bell. From an extension target of over 1200 down to a trend invalidation level at 800, these are your key decision points. The options market is pricing a 17.6% move, roughly a $180 swing. Inside that box is expected. Outside is where the real damage or windfall occurs. Use the cup close theory to gauge conviction. A close above the shelf signals control, while upper wicks indicate distribution risk. It's a tool for waiting scenarios, not crystal ball gazing. Scenario 1. A beat and raise keeps the squeeze going. If the revenue and EPS targets are met, the path of least resistance points toward the upper rail. Scenario 2 is the quote chop path. This is common for crowded names. A beat followed by a cautious tone can trap both sides. Often it's best to wait for the chop to resolve. Scenario 3. The red path. Any hint of peaking pricing power can cause a flush. Long-term bulls might see a dip, but for the over-leveraged, it means a margin call. Remember, trends overshoot, but never add size into a vertical move. The unwind is always faster than the climb. Respect the level, not the narrative. Here is your support ladder. From the pivot at 1040 down to the invalidation at 800, these are the shelves that matter for your risk management. Looking at the upside, the map shows levels that matter if the guide delivers. Structure first, story second. The recent move is thin. That means little resistance up high, but also little support below. Air pockets can lead to fast moves in either direction. Ultimately, the market expects fireworks. Being right on direction isn't enough. You need to account for the magnitude of the move. Let's dive into survival. When you're dealing with a 17.6% gap, a standard stop loss won't cut it. Price can simply leap past your order. You must size your positions assuming the worst case, that you lose the entire move. If that potential loss scares you, the position is simply too large. Account survival is the only edge that compounds. Remember, you cannot trade tomorrow if tonight wipes out your account. Here are 3 ways to engage without betting the farm. First, use defined risk instruments like spreads to cap your maximum potential loss. Second, trade the reaction. Skip the coin flip of the initial print and wait for confirmed levels once the volatility settles. Third, go smaller and longer. If you believe in the long-term story, take a smaller core position and add on weakness, rather than maxing out into the event. Keep in mind that there is no rule stating you must hold a position into the print. Sometimes, being flat is the most professional trade you can make. Your strategy depends on your current situation. If you are already long, have a plan to manage your exposure before the print, not while it's happening. If you are flat, you have the best seat in the house. You have zero pressure, allowing you to patiently trade the reaction off established levels. Looking at the technical scorecard, we see a strong trend, but with stretched momentum and crowded positioning. Discipline is your greatest edge here. The bottom line is that while the trend favors bulls, the chart is extended. Edge doesn't come from predicting the gap. It comes from mapped levels and risk control. This is our playbook. Whether the result is green, amber, or red, we have a pre-written response for every scenario. In a green scenario, we hold the gap to ride to the upper rail. In amber, we watch the chop. In red, we focus on gap fill levels. You don't need to know which branch the stock will take. You only need a pre-written response to all 3. Our house rules are simple. No position is a position, size for the gap, trade the reaction, define invalidation first, and put rules over feelings. Let's synthesize the dossier. We've analyzed the macro, confirmed the fundamentals, and mapped the technicals. Now, it's time to weigh the verdict. The macro picture remains dominated by the ongoing sector war. While AI capex stays intact, keep in mind that massive new supply hits the market in 2027 and 2028, and growth is starting to cool. Fundamentally, the picture is strong, but tread carefully. We are seeing record margins and earnings, but these are driven by aggressive pricing. The stock looks cheap on forward numbers, if those numbers hold. Technically, the stock is extended after a 300% run. With a massive 17.6% implied move, there is plenty of air below the current price. Focus on trading the reaction, not gambling on the print. The read-through is critical. Micron's print doesn't just affect them. It ripples through the entire complex, including memory peers, Apple, and the hyperscalers. Every key player is linked. Whether it's supply signals from Samsung or demand trends from Apple and the hyperscalers, look at how the entire ecosystem reacts. Our scorecard is clear. The macro is active. Fundamentals are solid, but technicals are extended, and event risk is extremely high. Stay objective. Bottom line, it's a great cyclical business at a parabolic moment. Long term, we are constructive, but into the print itself, it's a coin flip. Manage risk accordingly. Ready to run with us? Precision over noise, and rules over feelings. That is the hollow point trading way. Follow our operation to sharpen your edge. Starting July 1st, we launch our $100K to $1 million challenge. It's a transparent, rule-based campaign to compound a six-figure account. See the link to join in. The Inner Circle Discord goes interview only on July 1st. We prioritize the quality of our room. If you want in, this is the time to apply. Want to build your own process? The HPT Academy provides a full library, covering everything from macro reads and fundamentals to our proprietary cup close theory. Find all our channels listed here. From our website and Substack to our live updates on Discord, Twitter, and TikTok, keep connected with the operation. As a final reminder, this is market analysis, not financial advice. Trade responsibly, always account for risk, and do your own homework before placing a single dollar. Thanks for running the dossier. Share this with someone who needs a structured approach. Remember, dull entries miss the mark. Hollow points always expand.